Hospital stocks under pressure as rising competition in the space after Adani Group's foray weighs on the stocks beside Q3 earnings.
Escorts Kubota slips over 5% following a weak Q3. Weak outlook. The company's revenue growth stood at 9%, much below estimates of 35%.
Torrent Power falls after Morgan Stanley downgraded the stock to an equal weight from an overweight rating earlier, revising the target price to 1,413 rupees a share from over 2,026 rupees a share earlier.
Well, straight away, let's get to one of the corporates joining us on the show today on Midcap Radar. That's Insecticides India. The company's reported a mixed Q3. While the margins came in healthy, revenues were flat. Rajesh Agarwal, Managing Director of Insecticides India, is now with us on the show. Mr. Agarwal, if we could start with the top line first. So flat revenue growth in Q3. Break that up in terms of volumes and realization. And also for FY25, what are you likely to end the year with, considering that in the first 9 months, your top line has degrown by 3%?
The total degrowth is not 3%. It's very nominal, actually, and we should be able to make a recovery. So we had a strategy. The strategy was to sell the premium products, and very successfully we have done that. We have sold the premium products in the market, which has helped us in building our bottom line. So this year, in 9 months, we have made 128 crores, which is the highest ever profit made by the company, the PAT margin, which is 36% higher in 9 months if we compare with the previous year. So in the full year, we have the best profit made by the company is 122 crores. So that way, I can say that we are doing well. The market was tough, and technically Q3 is a lean quarter. Even Q4 for our industry, because it's a cyclic industry, generally Q3 and Q4 are lean. But the international market is changing. The market has already bottomed out and prices have started going up. And looking at that, I believe that B2C demand, B2B demand, and also international business, they all three are moving up in Q4. So there will be some better performance in this, and we should be able to make some gain in the top line also. But in terms of bottom line, I am sure that we'll end up with double-digit EBITDA margin, and which we have already shown in 9 months. So that will be the highest ever profit built by the company. And the vision is to bring the premium product and continue the sale of these premium products. In the previous years, we have launched about 10 products. There are more than 6 products in pipeline for the next year also. So these products are going well in the market, very well accepted. Like in last 2-3 years, we have launched many products, and these products are doing well. So
just some numbers, Mr. Agarwal, sorry to interrupt. So for the first 9 months, your top line was 1,694 crore rupees. What can you end FY25 with in terms of a revenue growth? And what will the contribution of premium products rise to? As of December, I think it's 62%.
Yes, this will remain around plus minus 62%, but last year this was 59%. Okay. There will be some growth. We are targeting a growth of 3 to 4% in the complete year. So which means that we are under pressure in this Q4, but I see the export sales growing, I see the B2B sales growing, and also B2C, and the performance of last 40-45 days is plus. So I'm confident that we should be able to break even this year with the positive note. So top line will be little positive. I'll not say very positive, but yes, for future we are ready by launch of these 16 products. 10 already come in and 6 also coming, and all these products coming in the premium segment. We are very confident that in
Mr. Agarwal. Understood that, yes. Mr. Agarwal, so at the start of the year, the guidance that you had given was 5 to 10% revenue growth. You are now paring down that guidance, hoping that you will see some growth as far as the top line is concerned. In terms of the EBITDA margin, what is the exact quantum that you're looking to end the year with? And what will be the corresponding PAT margin that you will end the year with? Like you mentioned, on account of the changing mix, you've actually managed to expand your margins at the expense of moderate top line growth. So give us a guidance where you will end FY25 at.
Difficult to give the exact number, but I will say that we'll beat the last year in the last quarter again. And since we are expecting some growth also, so this will be a good margin. So I can only say that the EBITDA is going to be double digit, positive EBITDA. So we are already 11.7% roughly in 9 months. So we should be able to maintain 11% plus anyways. What it will be, difficult to say today.
Okay. Getting back to premium products, I understand in 3 months it'll still probably be 62% in terms of contribution. But say 1 year, 2 years down the line, what would the contribution of premium products be? And secondly, exports is still about just 3% of your top line. You were hopeful of growing that. What is the outlook on exports and what's the growth?
Okay. These premium products, the vision is that we should cross 65% in the next year or 1.5 year. We have reached from 59 to 62. Next year, vision will be to cross 65%. And I'm very, very confident that we should be able to do that. And with the top line growth also, because this year the launches were a little late and the market was tough, the prices were declining because volume growth is much more than the value growth what we have got. So it was a difficult year, difficult phase, but the recovery has already started coming and we are seeing that recovery in all the segments. As I told you that we are going to grow everywhere. And regarding your second question, which was exports. Exports are showing a sign of growth. This year it will be beating last year, but the export growth won't be much, but will be beating last year. And the future for export is looking good actually. Again, we are going to keep the aggressive target for export because we have bagged some registration in South America and some more are expected. And European business also is expected to grow for us, which was very, very dull in the previous 2-3 years. Some business in CIS also maturing. So looking at that, I believe that these markets are going to open up. Also, Australia is going to open up for us. So ultimately, our white label exports and also the technical exports are going to start now. So this will give good boost to our international business also.
Thank you so much, Mr. Agarwal, for joining us, giving us a sense of how Q3 panned by and hopeful of a better Q4 and FY26. Let's now slip into a short break. The management of MTAR Tech joins us on the other side to discuss their Q3 earnings. Stay tuned.
quite a year it has been for the Nifty, right, this time around. But there are some stocks that have made records, not necessarily in a good connotation. And we'll look at some of those. You start off with the index heavyweight, that is Reliance Industries, and with a 5.5% drop that this year that the stock has had, this may end up being the first year since 2014 that the stock has delivered negative returns. Now, yet the street remains bullish, and most analysts continue to have a buy recommendation on the stock. Price targets ranging anywhere between 1350 to as high as 1950 rupees on the stock. But on to the other company that we are talking about is Asian Paints, and it wasn't a bad year until the last quarter results, but since then the drop has taken it to be the worst calendar year on record for the company. Now, in fact, since 2010 the stock has delivered negative annual returns only thrice, and two of those years being 2022 and this year so far. Most analysts now have a sell rating on the stock, targets ranging from 2080 rupees to as high as 3750, but the stock is veering more towards the former right now. On the flip side, Trent has been a wealth creator and a giant wealth creator at that, and it is also the top performer on the Nifty this year. The stock doubled last year.
Welcome back. There is a complete mayhem in the broader markets. The concerns are mounting. There is a bloodbath. The Nifty is down 1,700 points, and this is over and above the 1,200 point fall that we had yesterday, which means in 2 days, the Nifty has lost close to about 2,800, 2,900 points. The small cap index in 2 days, yesterday and today, has erased about 5.5% of its market capitalization. The advanced decline ratio, the gap between the two has only worsened. We're now talking about less than 200 stocks in the green for about 2,500 stocks in the red. So this is looking very, very ugly, very painful for individual stocks. Many of these high flyers are losing significant ground. Just stocks like Swiggy, Zomato, Ola, every single day these stocks are falling day after day on large volumes.
High valuation, high price, weak earnings. It's not looking
supply.
like a good concoction. Yes,
Yeah, there's so much supply in the market, but we've got a management waiting by to chat with us.
Right. So MTAR Technologies is the management. They reported a steady set of Q3 numbers. Revenues came in strong, but margins actually contracted marginally. To discuss this and more, we have Srinivas Reddy, Managing Director at MTAR Technologies. Mr. Reddy, thank you so much for joining us. You joined us at the end of Q2. Q2 was slightly challenging. Q3 appears to have been better. At the end of Q2, when you joined us, you told us that the FY25 revenue guidance would be 25% from the 30% you had envisaged earlier. You had the margin guidance at 21% from the 25% earlier. End of Q3, where do we stand and how do you expect to end FY25 at? Top line, margins as well as bottom line.
Yeah, we are still on track with that. We will be crossing 700 crores plus revenue by the end of Q4, and at a much higher margins of close to about 24% EBITDA levels to come at about 21% plus minus 100 basis points. So we are on track with that for this year. And for next year, we have a clear roadmap of a 30% revenue growth at about 24% EBITDA margin comfortable.
24% EBITDA margin. So correct me if I'm wrong, but weren't your EBITDA margins close to 20% in the quarter gone by? Are we looking at such a big jump in margins?
Yes, we have developed a lot of first articles. We have done a lot of work towards that. And we are back on track with our margins from Q4 onwards, where we'll touch about 24%, close to 24% EBITDA margin plus minus 50 basis points. So that's how we might end up with about 20% margins for the year. But moving forward, we'll go in the same momentum with about 24% EBITDA margin for the whole FY26 as well, with a 30% revenue growth.
So for FY25, where do you expect to end the top line at? I just missed that number. You're on track for 25%, is that right?
Yeah, the FY25 top line would be roughly around 700 crores plus. That's what it's going to be at the end of the day.
Understood. So slight moderation from 21% to 20%, and next year you're expecting to revert back to 24% as far as EBITDA margin is concerned. FY25, earlier you had indicated that the closing order book would be close to 1,400 to 1,500 crore. Your order book currently is slightly in excess of 1,000 crore. So 400, 500 crore, where are you seeing the order visibility at as far as Q4 is concerned?
We're going to expect major orders from space and nuclear divisions, and also from a lot of MNC customers. We're getting a lot of orders. You have seen that recently we have received orders close to even 400 crores plus. So we are expecting a lot of orders coming in, and hopefully all these orders will come before 31st March. So we'll end up with the number of 1,400 crores by end of the year. That's what we're looking at.
The budget gave a thrust to the nuclear power segment. What is your contribution from the nuclear segment? In what way, is the company now better placed than it was prior to the budget?
See, one is the announcement in the budget of the nuclear division. MTAR contributes a lot to the civil nuclear reactors in India, right, for the last 35 years. So definitely, as and when those tenders come in, MTAR would benefit a lot. We are expecting huge orders of nuclear coming in the form of the regular fleet reactors from Kaiga 5 and 6, and as well as the refurbishment of reactors. We're expecting 5 reactors to come in for refurbishment. So over the next 3 to 6 months, we're expecting close to about 1,000 crores of orders coming in, apart from what government has announced for the 220 megawatts, what they're looking at.
Understood that, sir. So as far as exports are concerned, Bloom, a major client, how's the order visibility over there? Have they recovered? They were also in a bit of a lull last year, like you had mentioned. Have they recovered? How's the order pipeline in that particular segment?
They're absolutely right on top right now with a lot of new orders with the data centers and the kind of orders we have received recently and the kind of numbers we're looking at for the next year. It's right back on track.
Could you quantify, the prospect pipeline?
Yeah, see, for next year itself, we might even look at about almost like 485 to 500 crores of orders being executed just with Bloom. Based on the kind of orders that we have received from Bloom Energy.
Thank you so much, sir, for joining us, giving us a sense of how the quarter panned by and the outlook as far as Q4 and FY26 is concerned. Let's now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Year as well, and starting 2014 the stock has had positive returns every single year. The street continues to remain bullish on the stock with price targets with as high as 9,350 rupees. Mahindra & Mahindra is a turnaround story. The stock has had its best year in terms of returns since 2009. The stock is up 70% this year as well, and only 3 negative annual returns in the interim between 2009 and this year. The street remains constructive, targets of anywhere between 2,700 to 3,700 on the stock. Now HDFC Bank, positive returns every year since 2013, but 3 of those last 4 years are returns in single digits. Yet, no analyst on the street has a sell rating on HDFC Bank with price targets ranging up to as high as 25.50. Now, FMCG is a sector that is disappointed as a whole this year, and HUL is among those disappointments. A 12% drop here, which has made it the worst calendar year so far since 2004, and yet has delivered negative returns only 4 times since 2007. The street, though, is optimistic, analysts giving targets of up to 3,400 rupees on the stock. Staying with consumption, Titan is set for its first negative calendar year after 2016, and since 2016 the gains have ranged between 10% to as high as 150% on the stock. The street, though, expects the stock to touch as high as 5,000 rupees, but the bears keep it at as low as 2,800. And rounding off this consumption theme is Nestle. If HUL was the worst year since 2004, this is the worst year for Nestle since 2002, and the MNC has given negative calendar year returns in these 5 instances. But most analysts have a hold or a buy rating on the stock, price targets ranging close to 2,900 rupees. Now, banks make an appearance here with IndusInd Bank, positive returns in 22 and 23, but the worst performer on the Nifty this year, down 40%, and is the 5th time in the last 7 years that the stock has had negative returns. Yet, 37 analysts continue to maintain a buy rating on the stock, targets ranging up to 1,950 rupees. And lastly, despite all the news flow, Adani Ports, news flow this year and last as well, Adani Ports has managed a positive calendar year return, the 5th time in a row that it has done so, and analysts too have a near consensus buy rating on the stock, targets ranging close to 2,000 rupees a piece. So the Nifty may have had a 9% return so far this year, but it is specific stocks that have grabbed headlines, some good, some not so.
Well, the consolidation theme continued to play out in 2024. With 40 million tons of capacity folding up into the hands of Adani Cement and UltraTech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as UltraTech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or pricing.
Welcome back to Midcap Radar. Well, there's been absolutely no respite as far as the selling pressure is concerned. A couple of stocks, especially from the healthcare space, the hospital space, are taking it on the chin today. Have a look at Max Healthcare. This particular stock is now down 5%. And the other stock that's taken a real beating today has been Apollo Hospitals, over 6% lower. Worries of impending competition is something that is keeping these stocks under pressure. But as we wrap up the growth code, let's now bring you an initiative by Grow and CNBC-TV18. We want to leave viewers with some essential tips and strategies. Here's a snippet of what Saket Ramakrishna, trader and founder at Quick Alpha, had to talk about common misconceptions in the trading world. Let's listen in.
What are the tips that you would like to give in your experience as a trader and now an entrepreneur to the young traders who are looking to venture into the markets?
So firstly, it's mostly about having the right mindset. So most of us are here without understanding what trading is for quick money. So just because we have seen in a lot of places where people have made, they post that they have made quick money, and also it is on the other hand a business where people sell dreams. So they sell tips, they sell courses, they sell a lot of things where they themselves are not making money, but they sell dreams of making money, and due to which a lot of people get lured and they get into this process of making quick money.
What are the common misconceptions that you would like to bust through this platform of these young traders and enthusiasts?
So first, going by the statistics, so mostly when you come to markets, you would be among the 93%, but not the 7% who will actually end up making money, right? So when you come into the markets, unless you're coming into investing, don't come with a hope that you will actually be making money. So try to avoid as much as social media noise and try to focus on the basics of it.
Tell us about your journey and what are the ups and downs that sort of you took a lesson from.
What really happened is, for my first almost 1.5 to 2 years, I only saw the market go up, because when I entered, I think Nifty was around 5,400 or 5,500. From there on, 2014, we had the election and market saw a fantastic bull run. By 2015, when I was into market, so I already had started F&O by then, right? So I had only seen a bull phase where the markets went from 5,500 all the way to 8,500, right? So in my mind, it was never that the markets can actually fall.
Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
For the second year running, Tamil Nadu stood out as India's top exporter of electronics goods. At $9.56 billion in FY24, the state's value of electronics exports was double than that of Karnataka and Uttar Pradesh, and the export orders it has received between April and September 2024 are already above $6 billion. In April, Tamil Nadu not only secured the pole position in electronics exports for the previous fiscal, but also registered a whopping 78% growth over its own numbers in the previous year. Incidentally, the state accounted for $9.56 billion in electronics exports out of a total national electronics export order value book of $29.12 billion. This meant that the state approximately accounted for 1 out of every 3 rupees that India earned in electronics exports through all of FY24. So it comes as no surprise that the state's electronics sector repeatedly made headlines through the year. Investments from Salcomp, Pegatron and Foxconn fructified, and as their plants commenced production, they added extra thrust to the state's export engine. And in September, American communications major Cisco launched its first Indian plant in Sriperumbudur in partnership with global electronics manufacturer Flex.
Cisco's partnership and the announcement made a huge difference, not just for Flex in India, but also in industry in itself. High technology products, highly skilled workforce, labor force, as well as the talent. And last but not the least is the manufacturing ecosystem, which means the supplier ecosystem as well.
It's this strong and fast-growing supplier ecosystem that the state government is banking on to fuel the brisk growth in electronics exports. It hopes the number will cross $12 billion in FY25, and that's just for starters.
The already existing infra will take us to 12 now, but what we are seeing is more down the value chain coming in, more components down the value chain. The entire supply chain probably, if possible, of Apple is something which we are all looking at. But the next year would be, we are looking at really bigger numbers. Right now we are at 35% of India's output, right? We would definitely want to go up.
To understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index holding on to gains of 0.7%. PM Modi's visit to France includes an extensive discussion with Macron on strategic cooperation, innovation and artificial intelligence.
I think this is going to be one of those years when the offtake in the state capex loans is going to be at its lowest point.
Nifty Bank closed lower yesterday, but relatively outperformed the Nifty, 23,365 and 49,871. Nifty Bank is coming off a little bit more.
10% increase in volumes for Congo, which is cardiac, oncology, orthopedics, neuro and gastro.
We do want to come out ahead of the industry growth and continue to maintain our lead.
साल 2030 तक हम 500 गीगावाट रिन्यूएबल एनर्जी कैपेसिटी ऐड करना चाहते हैं.
The sell-off is now extending itself for the 5th day in a row.
The rupee at its sharpest dealt at 86.63.
It seems like even the strategics are refocusing on India.
There's a lot of conversation about recalibration and strategy.
The meet is expected to drive investments worth around 10 lakh crore rupees across sectors.
Midcap index down 3.4%, small cap index down close to 4%.
Well, it is painful, and we are almost at 23,000 now, 23,028 on the Nifty. This is closing bell. We are starting a little early, of course, because of what's happening out there in the market. I'm Prashant. With me, my colleague Rupee, Rima here, and Nigel joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. The mid-cap index is down 3,000 points in a span of 2 days, 1,800 points lower today. And add to that the near 1,200 point fall that we had yesterday. 5.5–6% gone on the small cap index in 2 days. So this is really going to test the patience of the new investors who had only seen gains.
You know, so I'm sure most of us have been trying to figure out, calling people as to what's really going on. Some feedback that I received was that this doesn't look like mutual fund based selling. It's not MF suddenly throwing in the towel. It's not that. It's probably more to do with, either individual traders or retail investors or, family offices. There's a large middle which is not captured. It's neither FPI nor domestic institutions. They're not, domestic insurance firms or mutual funds. That large black middle is leading to this kind of a fall. At least that's what I'm picking up, because the sense and the sentiment seems to be preserve money wherever you have it. And a lot of these mid-cap stocks have run very, very hard. So one theory that I heard was it's preserve profit wherever you have it and get out. And the second was start booking some losses, because remember, you can offset your losses against, gains elsewhere. So maybe there's some kind of rejigging going on, but painful would be an understatement. 2 days running, extremely severe. Nigel?
Well, that's right. And one would say that the weaker hands are getting flushed out, but just take a look at the pain in the broader markets. There's a lot of pain out there. And, that was where the big money was made by a lot of retail audience. So that's why we're seeing a bigger sell-off out there. That's the broad feedback you're getting. It may not be institutional-led, but the kind of selling that you're seeing from the HNI's larger participants as well is quite a bit. The hope is that maybe we at least protect the recent low, which was at around 22,780 or thereabouts. So let's see how this goes. The problem is this tariffs. The US is talking about something. Now you have the European Union that's responded as well. And it could turn into a, whole-blown tariff war, which in turn will be very, very uncertain for the global equity markets as well.
Absolutely, and we'll hear more on that. By the way, as we get into the program, we are at 23,000. So let's see if we are able to hold this. That's basically nothing but the 20-day moving average. 23,004 as of yesterday's close, and we are at the 20-day as we look at the picture. But that's 1.5% on that index. Other indices are down 3%, almost 4% on the small cap index. So everything down kind of a day. Quite something. Let's bring in Rohit Srivastava, founder and strategist at IndiaCharts.com. Rohit, good to have you with us here, but we've seen markets puke it out all out. I think that's maybe the one expression which passed through my head. It does certainly seem that way. What's going on in your opinion, and where are we at? The bounce has not been that sharp on the up. So we got to about 23,800 or so, which was the low, 27th of January. And then the market bounced a little bit. It was expected. Broadly, the view was it'll maybe stretch a little bit more. But we reversed much faster. Where are we at, and where does it leave us?
Yeah, surely the quick reversal to the downside has probably been a surprise, because you've been at the end of a 4-month-long decline. So let us split this view into two parts. One is the medium to longer term, and one is the short term setup. Medium to longer term, I think since October, I've been anticipating what could end up being a year-long grind, which we may eventually end up calling a bear market. But it's essentially that you don't make new highs. You have many bear market rallies, you have sell-offs, and so on and so forth. So that is like in the big picture. In the near term, however, nothing happens one-sided. So if you had a pretty long fall over several months, you do anticipate that some kind of a counter trend move would happen. And that is the setup with which we were working, I think, from the week prior to the budget. And you're right that we didn't get past 23,800. And once again, we are back to testing the lows. My sense is that we are getting very oversold today, especially when we look at certain indicators, like we have our daily swing indicator, which essentially tells us the percentage of a group of F&O stocks which are showing negative momentum, and that's down to around 3%. So when you have only 3% of stocks showing positive momentum, 97% negative, that's usually a point from where markets will rebound. That doesn't mean today itself, but being very, very close to that point today, tomorrow, and you start recovering again. And what I would then anticipate is that we manage to protect the lows of late January, which is 22,800, or even better if we protect 23,006, or which is around 78.6% retracement of the bounce that we had seen. Then we should make one more attempt to go towards 24,000. So that is the first thing I would think about. Can we really make that attempt? Because nothing has really happened in the global markets to cause this kind of sell-off, and we need to also come out of some medium-term oversold conditions. Like a lot of us have talked about the positioning, which is the FIs being extremely short, the client data being extremely long, and they are at the opposite ends of the spectrum. And whenever that has been the case in the past, we have seen markets turn around for some time. And that has not happened yet. We haven't seen any significant short covering. Now, we can argue whether this is directional and the market keeps falling. Definitely, markets are supreme and it's possible. But based on data and based on historical patterns, we wouldn't anticipate that right away. I would expect that markets try to bounce back, loosen up the negative sentiment much more before you get another meaningful sell-off. However, the hard part would be to say the same thing about mid caps relative to large caps. I think that is where the next debate shifts then. But these are the nifty levels with which we'll be working, and still looking for that it does not significantly sell off yet. You might attempt another recovery into March.
Rohit, hi, afternoon. So that's the near-term outlook, right? That we've possibly made a bottom today, tomorrow. There will be a little bit of a bounce back, maybe another meaningful correction. But what about the trend in the market for the next 6 months, 9 months, or 2025? Are we in for much lower levels? Broadly, directionally, are we headed down? If you look at it from just a larger time frame, and talk to us on what's happening on the mid and the small cap stocks.
So when we take a slightly longer time frame, we've, historically, when we would go into a market correction, consolidation, we are used to the idea that, Nifty, mid caps all generally move in tandem. But 2018 to 2020 was a very, different period, which, changed the way the market behaved. And it did so also in an environment where we did have a lot of mutual fund flows starting. That was the starting point of your mutual fund Sahi campaigns. And so all that money kept the large caps elevated even when the mid caps were falling. So that is the main thing to remember. 2018 to 1920 till COVID happened, the Nifty was still holding up, coming back to 12,000 after each sell-off. But the broad market was still in decline. I think that is the first thing that we can at least anticipate, that there may be further weakness in mid and small caps. After each bounce, they may still keep selling harder as we are seeing today. But somewhere the large caps may find support because money in the end has to go somewhere. A lot of money is flowing into funds. They will only reallocate. They will decide, okay, let's not buy too much of mid cap. Let's buy this. They're hybrid funds that will shift back and forth. And so at some level, you end up getting buying coming back to the large caps. And so that may be more supportive of Nifty, Bank Nifty, relative to mid and small caps. So that is the first scenario we should keep in mind. What happened between 18 and 20 can repeat. The alternate would be to have something like 2015 or 2012, where for a 12-month period, both Nifty and mid caps made lower lows and lower highs, and you gave up around 20-30% over a 1-year period. That is the second scenario. But I think given the similarities and more recency, the first scenario has a greater likelihood of playing out. But we will see as it progresses. It clearly highlights one thing, that be careful of mid and small caps. I think that much is clear.
Absolutely. Rohit, hi, good afternoon. I was actually doing homework for the other show that I also host, the personal finance show. And since the pain in the mutual fund part is also really showing up, People are asking. It's all very fine to say long-term India story, but the thing is, people still pick up their, funds and look at the NAVs, and they're down quite sharply. Maybe I'll put up this data for everyone's reference. The mid-cap category, mid-cap funds is the category, in the last 3 months is down about 8%. The small-cap category is down 10.5%. That's 3 months. And not just this, the 3-month correction has been so savage, it's cut out the whole year gain as well, down to about 7% gain average in small-cap funds, which is, people will really, sit up and ask questions. Is the risk worth it if my 1-year return is coming down to 7-8% now? Of course, these are absolute returns. They're not rolling returns, so we have to take that in perspective. But Rohit, the question is, what is to be done here? I think, and that's something that people are grappling with. Now, whether you're owning mid and small caps directly or via funds, would you say that this is the time to book whatever profit you have, or do you think that this is the time to just sit tight in at least some sectors and companies? What's the advice? What should be done with anyone's mid and small cap holdings? Anyone who's watching this absolute carnage play out?
So what has to be done is that every time you get a bounce, like we got one in December also, where the small cap index almost made it back to the highs. This time around, it was much smaller. Every time we get these 2-3 week rallies, you need to reduce your weightage towards mid and small caps in favor of large caps. Now, this is usually not true for individual investors who have only, say 10 stocks or so, and they've selectively bought something which they have a 5 to 10 year time horizon for growth. Then it becomes a different game. But when you're really investing only in funds and you're watching 6-month, 1-year performances, it makes a lot of difference if you have over allocated to a particular segment, which most people are saying is still relatively overvalued. So reducing that weightage in favor of large caps or particular other sectors that can do well in the interim might be one way to deal with the problem, because otherwise you'll keep seeing poor performance or even negative performance stretch further on a 6 or 12-month basis, because this segment might continue to weaken in this time period. So that is the thing to keep in mind. And second is also consider alternate asset classes. Very few people talk about. One of the places that have done well has been gold, and gold as an alternate allocation apart from equity is also something that a lot of investors should consider during such times.
Hi Rohit. Rohit, I wanted to ask you about the Nifty Bank. That in fact has taken a sharp downtick. It's at around 49,300. One would have thought a sector where there is valuations which are pretty okay. You have RBI action as well that's taken place, and bulk of the estimates, going ahead as well, they don't appear very, unbelievable, or they appear that they've taken into account yields will fall a little bit. But that one, in fact, is at a very, very crucial level. Where is that one headed?
Yeah, so like you said, it's a crucial level. If we look at all the major indices, it's one of the ones that is losing the least. The Bank Nifty, it's down less than the Nifty. It's not broken the 20-day average, which is currently at 49,272. So it's actually doing relatively better. Of course, it's down because the market is down, and so everything is down. But on a relative basis, if I look at the performance from the 5th of December when the market peaked, the top sectors that we actually see I see on the screen right now is private banks. That is one that comes right on top, followed by IT, banking, and metals. So these might be the areas. So when you see on a decline like this, that these are the areas where we are seeing relative outperformance, that is sort of where I would expect things to remain better when even the markets rebound. So they would be places where I would look at allocating money at this point of time from a maybe at least a 1-month perspective.
Okay. So again, the view, Rohit, is large caps see a bounce from here, maybe the Nifty, right?
Yeah.
Mid and small caps can't say. You're saying institutional behavior could move towards large caps, and that may cost mid and small caps, right? Because you've got to, you basically mark to market to the benchmark, and then you can't, it's tough there. Individual, of course, portfolios, that's an important point, the differentiation. And sectorally, anything looking, interesting or poised for further declines?
Further decline. So one of the surprisingly most weak segments is FMCG. I think we all thought, including myself, that post the budget it would hold up a little longer, maybe go further than that. but it's broken that entire shelf. You know, the FMCG index, the Nifty FMCG was holding 55,000. It held it around 3 times between late November and, mid of January. And after attempting a breakout on the upside, it failed. And now it's making new lows. It's broken the entire range. So that looks like a very, very weak segment right now, despite whatever we may have tried to do. And it means that that's going to keep making lower highs and lower lows. So even when it does bounce, I doubt it will possibly go back to even where it was, pre-budget or around the budget. So that's one of the weakest areas I can see.
My question was weak or strong? Anything looking interesting also from a buying perspective?
On the strong side, I would actually think metal space, even though I know the tariffs that have come overnight are on steel and aluminium. But when you actually look at commodity prices, they are rising. You know, the copper prices have been going up for the last 6 to 7 days consecutively. Aluminium prices are close to a breakout point. So they could very well follow copper on the way up if they go past around, say, 2690. That would be a good breakout point above which aluminium would get strong. Even there are other commodities, things like coffee, which nobody's looking at, which are making all-time highs. So basically what I'm saying here is that commodity prices, and sometimes this is how cycles work. It's bonds, equities, commodities. Bonds tend to peak out first, equities next, and then commodities are last. And so money does get reallocated from equities to commodities in a last blow-off, and which is why sometimes inflation risks remain elevated till later in the cycle. And we are seeing now some kind of a pickup in commodity prices. So commodity-related stocks could be another area which could be positively surprised.
Rohit, thank you very much for that. Just a word on gold. There are two, game-changing events that everyone's watching out for. One, is there a possibility that the US Treasury will revalue its gold assets? So it's currently valued at $42 per ounce, but the current market rate of gold is about $2,900 an ounce. And increasingly, there is speculation that the US Treasury will revalue it at the current market price, which basically reinforces confidence in gold as an asset. And secondly, China has allowed a pilot program which allows insurers to invest in gold. So it takes money away from the US dollars and it will put them in gold. And that again could drive gold prices. So that's just a quick update on gold. But let's move on and talk about the broader market and the panic, the big sell-off, the mayhem that we're seeing there. Now, FIs have sold shares worth 1 lakh crore rupees in 2025. Sudarshan is here with the numbers.
So market has taken a big knock in the last few days from their recent peaks, especially in the broader markets. Both mid-cap and small-cap indices are down nearly 20% each. And in just last 2 sessions, both these indices, mid-cap and small-cap index, are down 6% each. So what would be the main reason? If one of the many reasons, if you could mention, that is big FIs selling. Just in 2025, basically in January and in February, if you accumulate, FIs have sold shares worth nearly rupees 1 lakh crore. And from October 2024, FIs have sold shares worth nearly rupees 3 lakh crore. Now, if you look at the mid-cap stocks, there are 100 stocks. So nearly 30% of those stocks are at or near to 52-week lows. And all the stocks have fallen up to 60%, with 60 or 70% of them have fallen more than 30%. Now, for Sensex and Nifty, fall from their record highs are in the range of 11 to 12%. But look at the broader markets. Mid-cap index from record highs down 17%. Small-cap index has fallen 19%. Nifty Next 50, earlier it was known as Nifty Junior, it's down 22%. And Nifty SML 250 is down 19%. And if you look at the sectoral indices, the fall is more severe. Media index down 32%, energy 30%, PSU 28%, realty 26%, PSU bank 26%, and metal 20%. Now, if you look at all the stocks, obviously PSU stocks are topping the list, with top losers being MRPL down 60%, Cochin Shipyard 55%, Vodafone Idea 54%, Hind Zinc 49%, Oil India 47%, Hoodco 46%. These are the stocks in the mid cap. If you come to the small cap, Sterling and Wilson 64%, Chennai Petro has fallen 61%, Raymond is down 59%, Jupiter Wagon 57%, Titagarh Rail 56%, ITI 53%. So now what's next from here? There was an expectation from earnings that also seems to have vanished. Number of companies which have reported earnings so far. So number of companies reporting below than expectations is much more than the companies which have reported earnings which are higher than estimate. So we'll have to see how the next few days pan out. As of now, it's a big fall that we are seeing in the market.
Okay, all right, indeed. And a lot of these stocks have fallen in a big fashion from their highs. So Darshan, thanks very much. That's interesting data. Just puts the fall in perspective for us. We have to slip into a quick break at this point in time, come back with some more perspective, and we'll have Adrian Moat join in as well. He's been a long time India veteran watcher. So what is he making of the Indian market's underperformance? Back with that in just a bit.
Groundwork for this is already in place. In January, Tata Electronics announced an investment of 7,000 crore rupees towards expanding its components plant in Hosur. Further, Taiwanese electronics major Foxconn has committed 13,000 crore rupees in further investments, and US-based Jabil has promised 2,000 crore rupees. This means Tamil Nadu will soon host 4 of the biggest global suppliers of tech giant Apple, and as more come in, $12 billion in exports may be just a portion of what the state clocks in 2025. In Chennai, Jude Sanath.
Rural economy came under great pressure during the large part of CY 2024, that is calendar year 2024, especially in the microfinance segment. The sector is expected to see pain in its business going into 2025 as well. Let's take a look at the numbers. So AUM growth, that is asset under management growth, which was at 26% YOY last year, that is in 2023, has declined to less than 9.5% growth year on year this year so far. So growth is expected to further slow down as lenders battle various issues ranging from over leveraging of customers to credit cost to asset quality pain, etc. So the biggest impact has been seen for Spandana Spurti, ESAF SFB and Credit Access Grameen in 2023. All the lenders saw improvement in their asset quality, but in 2024, ex of Satin Credit Care, all of them witnessed huge pain in their asset quality. Highest pain was seen in Fusion Finance. Amount-wise, these lenders saw gross NPA decline by 32% in 2023, and then it rose by 79% in calendar year 2024 so far. Massive rise was seen for Fusion Finance, Spandana Spurti and Credit Access Grameen. They saw their stock price and valuations also decline due to lowering of growth and deterioration in the asset quality. Now, highest decline in valuations on a one-year forward price to book value has been for Credit Access Grameen, Fusion Finance and Equitas Small Finance Bank. Marginal improvement was seen in lower valuations of Ujjivan Small Finance Bank and Utkarsh Small Finance Bank. The underperforming Nifty this year so far. On year-on-year basis, while Nifty has given a return of 17.3%, these lenders have given negative return ranging from as low as 5% to as high as more than 67%. So from 52-week high, if you take a look, Nifty has given a negative return of almost 7%, while these lenders have given negative returns ranging from as low as 31% to as high as 73%. Highest negative return is from Fusion Finance, followed by Spandana Spurti and then Credit Access Grameen. Let's look at the outlook for 2025 given by ICRA on this sector. Stricter lending norms for microfinance shall improve the credit safeguards, but will pose challenges to near-term outperformance or the performance of the sector. Borrower rejection rates are projected to increase significantly as over 20% of the borrowers are expected to be impacted by the new guardrails set by MFIN. Now, NBFC MFI's AUM growth will compress to 0 to 5% growth in FY25 from 29% that they had in FY24. Credit cost is expected to be at a high range of 5.4% to 5.6% for FY25, which along with margins is expected to compress the overall profitability of the sector. The sector has challenges stemming from over-leveraging of their borrowers, socio-political disruption, as well as operational challenges largely related to the high employee attrition seen over here. There is significant downside risk to the near-term loan quality of the sector.
Welcome back. We are continuing to track what's turning out to be another brutal session for the market. 3.5% gone from the mid-cap index. The Nifty is nursing losses of about 1.5%. We have now, as promised, Adrian Moat joining in this leg of the conversation. He's someone who's been watching India, tracking the Indian market for many, many years, for decades. And therefore, that perspective is going to be very useful right now. Adrian, great to have you on. Thank you for taking this quick call. You know, investors in India are not really used to long periods of underperformance, but that's exactly what's playing out now. The growth valuations are perhaps coming back to haunt us. What do you make of the big sell-off that we're in the midst of? It's been a time-wise correction, but now the price correction is also getting pretty savage, especially in mid-caps and small caps.
It certainly is. And, you know, when you look at the charts, the technical situation looks very poor. And I was just looking at how even the Nifty, you know, failed to break above its 50-day moving average, is moving down. And then we've got another sell-off. So there doesn't really seem to be any sort of technical level for the market at this point in time. And, you know, if you go back to your earlier point, which is the valuation of the market, this remains a very expensive market, which is justifiable if it is generating high growth. And I think investors have been disappointed both at the macroeconomic level, but probably more importantly at both revenue and profit growth levels in the market. So this is going on against a backdrop of India being a big outperformer, emerging market funds having a good exposure to India at a time where we've got rising U.S. interest rates, which put pressure on current account deficit countries, including India. And we've also, surprising, considering you'd think it would be the center of the trade dispute with the United States, Chinese equities doing quite well at the moment. So I think that the mindset here for investors is, look, I've been long an expensive market. It's not delivering the level of growth I was expecting. And at the same time, I'm very underweight market like China, which is surprising me by performing well. That might be partly driven by the whole DeepSeek story and people perhaps appreciating the level of opportunity in very cheap Chinese tech names.
You know, the funny part, Adrian, is that all this, if we, for instance, talk about the latest rumblings, which is all about tariff and tariff wars, if anything, I guess markets like South Korea or Taiwan or, of course, China, they're directly more impacted. India is still a very inward-looking market, and our net exports to the U.S. are not that significant in the larger scheme of things. Yet, like you were saying, the Chinese market has started doing better. We're not seeing a big shakedown over there. So, in the near term, do you think that could be an added negative for India? Should we be prepared for that China starts doing better despite these trade wars?
Well, I mean, it is doing better despite the trade wars, and I think you are already seeing a flow impact. Remember here we're talking about the Indian equity market as opposed to the Indian economy. Your IT sector is very sensitive to U.S. immigration policy. And there's clearly a dispute between, let's say, the heads of the big tech companies and those that are more MAGA-centric about whether visas for skilled workers should be given out. And if they're not, that is pretty bad news for the Indian IT industry. You've got a lot of steel companies and commodity companies listed, and if you're getting tariffs on the import of steel and aluminium into the United States, there is an impact at a sector level there. But I think a lot of this comes back to just the results season. The results season was disappointing. And when you're an expensive stock and you disappoint, you are going to see share price corrections. So I would suggest quite a lot of this is micro. It's about the earnings disappointing relative to the valuation.
You know, there are so many stocks which are at fresh 52-week lows. Swiggy, Delivery, MRPL, Motherson Wiring, NCC, LIC, GAIL, Coal India, IOC. All these stocks are now hitting fresh 52-week lows. And these are stocks which have fallen 35, 40, 50% from their 52-week high. So, Adrian, what's the advice that you're giving investors now? Sell more of Indian shares, or do you think now, after the correction, there is some relative comfort?
I wouldn't be buying at this point in time because you need to, you know, as we've seen, let's say in markets like China, when, you know, the share market peaked a couple of years ago, the correction phase can be quite protracted as valuations move back to, you know, the growth to a level that would be justified by the growth rate that they're delivering. I think the retail investor in India has a large exposure to equities. They've done well out of it, and now they're going into a period where that exposure is beginning to hurt them. And they might be willing just to, for a period of time, park a bit more money in the fixed income market as opposed to the equity market. If you're a high-frequency trader, I would still be on the sell side. As a saver, I would be standing back and not buying into this weakness.
Okay, I would not be buying into this weakness at this point in time. Adrian, it's a pleasure. Thank you very much, and I hope you come back and speak to us once we know what really comes out of the sort of, you know, talks between President Trump and PM Modi. That's essentially going to be over Wednesday and Thursday, and I think markets will remain very, very sensitive to it as well. Thanks indeed. Well, sorry, go on. You wanted to say something?
I'm sure the President of the United States will say they're the best ever talks he's had.
But do you think it'll yield a positive outcome from an India perspective, or you think at the margin, you know, whether it makes a real dent or sentiment-wise, you think it'll be positive or negative by the end of it?
I think for an hour it'll make a difference, and then there'll be another news story coming out from the White House. You know, I'm getting to the point where I think we're better off watching cricket rather than Trump's Twitter feed for our own mental health, and probably for the performance of our portfolios, because I think it's very dangerous reacting to all the noise that's coming out.
No, absolutely, and it's been overwhelming. Is the Twitter feed, and of course then there's the other stuff, and it doesn't stop. I mean, Saturday, Sundays are not sacrosanct either. And you hear something or the other over the weekend when you come back on Monday. Thank you very much, Adrian. Appreciate you joining us here on CNBC-TV18. I think, you know, the market just about holding the 23,000 mark, 360 odd points down in the Nifty. So that's opinion, both local and some global stuff as well.
The thing is, by the time an executive order goes out in the evening, 11:30, you never know. By 6 in the morning, maybe a part of it has been repealed, or someone else has done something else, or there's another tweet putting it on hold. So, I mean, this is an extremely exciting time, if I were to say optimistically.
Exciting for the news cycle. Absolutely for the news cycle.
Exciting in double quotes. Okay. All right. I think we have to take a very, very quick break. As we do that, let's get you some more snippets from the growth code. This is, of course, an initiative by Grow and CNBC-TV18. We want to leave traders with some essential tips and strategies. Here's a snippet of what Saket Ramakrishna, trader and founder of Quick Alpha, had to say about common misconceptions in the trading world. Listen in. We'll take that break and come right back.
What are the tips that you would like to give in your experience as a trader and now an entrepreneur to the young traders who are looking to venture into the markets?
So firstly, it's mostly about having the right mindset. So most of us are here without understanding what trading is, for quick money. So just because we have seen in a lot of places where people have made, they post that they have made quick money, and also it is on the other hand a business where people sell dreams. So they sell tips, they sell courses, they sell a lot of things where they themselves are not making money, but they sell dreams of making money, and due to which a lot of people get lured and they get into this process of making quick money.
What are the common misconceptions that you would like to bust through this platform of these young traders and enthusiasts?
So first, going by the statistics, so mostly when you come to markets, you would be among the 93%, but not the 7% who will actually end up making money, right? So when you come into the markets, unless you're coming into investing, don't come with the hope that you will actually be making money. So try to avoid as much as social media noise and try to focus on the basics of it.
Tell us about your journey and what are the ups and downs that sort of you took a lesson from.
What really happened is, for my first almost 1.5 to 2 years, I only saw the market go up, because when I entered, I think Nifty was around 5,400 or 5,500. From there on, 2014, we had the election and market saw a fantastic bull run. By 2015, when I was into market, so I already had started F&O by then, right? So I had only seen a bull phase where the markets went from 5,500 all the way to 8,500, right? So in my mind, it was never that the markets can actually fall.
Or return on asset can decline massively for the lenders in large part of 2025. They are strongly capitalized, hence incremental capital requirement for loan growth will be lower due to expectation of slowdown in the overall loan growth of the sector.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steel makers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty along with the onset of a seasonally good quarter could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025. Welcome back. Well, the markets continue to reel under pressure. If you're, trying to look for a couple of positives today, one is the rupee, which has pulled back a little bit. That's point number one. Point number two is, in the last 1 hour or so, at least the Nifty has managed to defend the 23,000 odd mark. And point number three is the Nifty bank. If you pull up the 20 DMA as of now, it breached it intraday, and now it's holding about that. And for the next, 50 minutes or so, you'll want these levels to hold out, which gives the bulls a chance to fight for another day as well. So that's at least the hope. It's a weak trading session, no doubt. Mitesh Thakur is back in. Mitesh, you had told us you've taken your long positions down, but have you all started shorting the index now? Are you bracing for a bigger pullback as well from these levels?
Oh, we have. So, instead that the long view has gone wrong, then I was hoping that there could be some consolidation, and the markets have actually broken the 23,200 levels as well. So there's no sign of reversal, and I don't want to take a shot at these levels given the fact that we are slightly unfavorable risk reward equation I was on. So we've got to wait it up for the next opportunity. Till then, I think trading should be slightly more on the stock specific basis. I have a sell on Tata Communications. Keep a stop just above levels of 1550 here for a 1450. 1460 kind of a target. Similarly, Tata LXI is also giving a fresh negative crossover. So sell here at the stop at 6200 for targets from 5940.
You just apologize to him.
Okay, all right. Mitesh, got it. Thanks very much for the calls. We'll come back to you in just a bit. Let's move on and look at some stocks as well. The market, of course, as a whole has been pretty troublesome. Nifty is still trying to hold on to 2,300 for what it's worth. Like I said, let's come down to some stocks. One of the worst hit on the Nifty is actually Eicher Motors, or even we should point out Apollo Hospitals. Apollo is now down 6.5% after a pretty decent quarter. But I think maybe it's the added weight of the Adanis getting into the healthcare space. Maybe it's that. Maybe it's just the general market sentiment. Big knock on Apollo Hospitals. The other one which is falling as much as this is Eicher Motors. So what's plaguing Eicher? Clearly the numbers haven't gone down too well with the street. Sudarshan's joining in with more details. Sudarshan, margin was?
So Eicher Motors is top, Nifty loses, and it seems that market is concerned with the same issue that we have been highlighting since morning. That's about the margin. It's about what would be the level of the margin that company would be comfortable with. Now, remember last quarter after Q2 earnings, company had raised this issue that it would prefer growth over margin. And you can see that over the last few months, volumes have been healthy. Every month, company has been reporting volumes of more than 90,000 units. And in Q3, total volumes were up 19%, up both sequentially and year on year. But what about margin? Margin for Q3 has come in at 24.2%, which is down 200 basis points year on year, also down against our expectations of around 26.4%. And some of the factors which have impacted the margin is the adverse product mix. Nearly company had launched one product that is Bullet Battalion. It's a low margin product, and it might be helping the volumes to go up, but on the margin front, it's impacting negatively. And another is due to heightened competition, companies unable to take price hike. So these are some of the major reasons. That's the reason that margin has been under pressure. But company will have to take a call. What will be the level of the margin that it's comfortable with?
Today, while UBS is downgraded, Eicher Motors posts the Q3 numbers. Morgan Stanley says growth over margins is the right strategy. But with the stock pricing in high growth and high margins, achieving both will be tough. Their target price is all the way down to 3,855. But Sudarshan, Escorts Kubota, also very weak set of Q3 numbers. Commentary here was downbeat. Give us the details. Sudarshan? If you can hear me, tell us about Escorts Kubota.
Well, Escorts Kubota, it was an all-round miss. On the earnings front, company has performed much better than, much below expectations on all the front. Revenue was below estimates when margin has come at 11.4% against our expectation of 12.4%. But more than earnings, what has been more problematic is the guidance. Guidance that company has given for FY25 is very weak. On the volume front, it says that due to the transition, it's going to increase the construction equipment price, and in resultant, it would impact the volume. And second, company has been also unable to take the price hike. And on the margin front also, it says there will be a gradual increase, but company is unlikely to see a major jump in the margin. And on profitability for FY25, it's saying that it's unlikely to see any major change if you compare versus FY24. Now, if you remember, yesterday only M&M had come and it had given the guidance for tractor industry that in FY25, growth is likely to be in the range of 6 to 7% for FY25. And that means that in Q4, growth of tractor industry is likely to be much more than 15%. But it's for the industry. We'll have to see what exactly it would be for Escorts Kubota, because on volume front also, every month, the volume that company has been reporting has been below expectations. So results were weak, but more problem is the weak guidance.
Okay, thank you very much for that big crack seen in many of these auto names. Realty Index is the worst performing index today, and that we'll get that up for you on your screen. But ahead of Axis Capital's India flagship conference this week, Neelkant Mishra discusses the potential fallout of the US reciprocal tariffs on India. And Atul highlights the risk of high equity supply in 2025.
While there is a lot of global turbulence, the levers for growth are completely internal. So there will be some impact. As we have estimated, if there are reciprocal tariffs, and this was done before the headline rates were cut in the budget, if US was to impose the same rates as India imposes on US imports, you would see an impact of about $7 to $8 billion. But I think that number is going to be a lot lower because India, as you must have seen in the budget, has actually cut those numbers. There is, I think, significant global uncertainty. I think there is, the more the uncertainty on investment. And therefore, it makes sense to be a bit cautious on external demand.
23, we saw total activity of around $15 to $18 billion. In 24, we saw around circa $40 billion. In 25, we could see as high as $50 to $55 billion of sale through various corners. So that's the supply that is going to hit the market. As long as we have the domestic flows which are robust, and there the key indicator to watch out for is the SIP flows. I think as long as the SIP flows are adequate or in line with what we are seeing, we have no reason to be worried or concerned about.
India is in vogue for a number of international brands this season. Rupee Upadhyay, CNBC-TV18, Mumbai.
Hello, I'm Rupee Upadhyay, and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports.
budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinion.
Amazing. There are many biases that we need to think carefully about. That is why I am grateful to my friend, President Macron, for hosting this summit and for inviting me to co-chair it. Friends, AI is already reshaping our polity, our economy, our security, and even our society. AI is writing the code for humanity. AI is writing the code for humanity in this century. But it is very different from other technology milestones in human history. AI is developing at an unprecedented scale and speed, and being adapted and deployed even faster. There is also a deep interdependence across borders. Therefore, there is a need for collective global efforts to establish governance and standards that uphold our shared values, address risks, and build trust. But governance is not just about managing risks and rivalries. It is also about promoting innovation and deploying it for the global good. So, we must think deeply and discuss openly about innovation and governance. Governance is also about ensuring access to all, especially in the global south. It is where the capabilities are most lacking, be it compute, power, talent, data, or the financial resources. Friends, AI can help transform millions of lives by improving health, education, agriculture, and so much more. It can help create a world in which the journey to sustainable development goals becomes easier and faster. To do this, we must pull together resources and talent. We must develop open source systems that enhance trust and transparency. We must build quality data sets.
All right, that's Prime Minister Narendra Modi sort of addressing the August audience there. And of course, his next stop is going to be the US, where all eyes is going to be on Prime Minister Modi and President Trump as they engage in talks. Tariffs top of mind, and that's going to be all of the sort of news cycle over the next 2 days, Wednesday and Thursday. Jitendra Sriram is with us, Senior Fund Manager at Baroda BNP Paribas Mutual Fund. Jitendra, good to have you with us here. Thank you for your time. You know, the screen is negative, so the price makes you negative even if you want to be a little constructive or positive, but you must look through it. If you have time on your side and if you have money to invest, what are you doing, Jitendra? And how are things looking? Is it looking so negative, or what's the view here from here?
Yeah, so broadly, I would say I think the correction has been quite intense and quite rapid as such. So I would think that at this juncture, it actually looks like it is a little bit overdone for near term, because at least from what we can see on the capex front, the reports that we are picking up, at least the capex on the ground from the governmental sources and all, seems to be picking up. So our take is that at least the earnings momentum should improve from here on. So the kind of we were undershooting on the earnings estimates all through first quarter, second quarter. My take is that we'll probably be closer to expectations, at least on the large cap odd side. Maybe the small cap still has about a quarter or so to go before it starts recovering. But I would think that at least certain segments are starting to look far more attractive now.
So which would be the sectors where we will see earnings growth revert, where there is opportunity sectorally? And where are the small cap pockets where you think that the recovery is a little more delayed now, 1 to 2 quarters out?
So I would say that broadly, if I look at it, at least the exporting segments is something that we are clearly seeing some kind of better traction come in, because, a lot of their pains were early on. So whether it's healthcare, whether it's IT, all these segments are starting to look a little bit more promising. There is a margin uptick that is expected by the street going forward. So those are areas that are clearly positive. The second is also that the Madam FM has put in a lot of money into the hands of the middle class now post the budget. That impact will be starting to felt through from April onwards. So hopefully that should also lead to some amount of discretionary pickup going forward. And that will again be an area where you could see some improvement and uptick coming through on the consumer discretionary side. So those are areas that are clearly looking positive. I would say that, where it could still take a little bit of time is especially those exposed to some of the capex thing, because capex, what is happening is a lot of the announcements are happening right now, but it might take some time before these investments are crystallized, move on the ground, that secondary order giving out happens. I think that might be a little further out then.
Okay. Jitendra, hi, good afternoon. Slightly different question, because I've been sort of trying to figure out how mutual funds are looking at this big fall and, what's the sense. The monthly data is going to come out only tomorrow, but I think the sense that I got from a couple of people is that it's not like suddenly the investors are shutting off the tap and flows are drying up. But what have you been hearing at your AMC and around in peers in terms of redemption pressures, especially for mid-cap and small-cap funds?
So it's very similar to what the news coming to you, in a sense that there is no panic as such on the retail side. See, retail is also confronted with a couple of things. On the tailwind, of course, you have this big rising equity cult which is there. The second is more money in the hands of consumers. All these are pro the equity theme overall. Of course, the headwind is that, in some of, especially like SIPs into, say, the small cap segment or something, you are seeing now the 1-year return being, say, probably about negative or something like that. So you could have a little bit of a headwind there. My take is that, the retail has also evolved over a period of time. They don't panic as much as they used to in the past. So I would assume that they would probably ride through it. And we are not seeing any, any kind of material, people pulling out money or something like that. What we are seeing is that, okay, the positive trickle that used to come in, that has probably, marginally come off, but it is still a positive.
Okay, all right, Jitendra, I request you to stay with us. We're going to come back to you. We want to continue this chat, but for the time being, it's 3 p.m. and we have Nimesh who's joining to tell us what he's making of today's fall. Nimesh, what's the feedback that you're getting? Surbhi earlier alluded to the fact that it may or may not be institutions, who are selling a lot, but it could be more the domestic hands. What are you picking up?
So, Nigel, three things which a lot of markets have been talking about and focusing on. One, is there a very large FIS selling? The answer to that is no. Okay. I haven't heard any large basket selling or an MOC sell flow at any large institutional desk. So, there is selling. Of course, that's been the data which has been showing up, but there is not very large selling which suggests a 300-point cut on the Nifty or 3% fall in the broader market. So that's the FI part. Yeah. The second part is, are there redemption pressures in domestic mutual funds? Even to that, the feedback seems to be that there are no any signs of redemption pressures in the mutual fund industry, so to speak, as we speak, right? Good. The only thing is, from the DI point of view, from the domestic mutual fund point of view, the participation has slowed down clearly. I was talking to some large institutional desk, and the feedback is, if they offer or show a 10 lakh shares of bid, the bid is only for 3 lakhs or 4 lakhs. So clearly, from the mutual fund side, the aggression to buy in such a market is slowed down clearly. So even that is impacting the stock price to some extent. I guess what we are seeing is literally a carnage in the broader market name. So looks like that's more of panic selling from retail and HNI investors, or for that matter, who are individual investors who are directly investing into the market. So that's the pocket which seems to be panicking now. The mid-cap index is down 3%, micro-cap, small-cap. The SME IPO index is down 4.5% in today's market. So that clearly shows that there is pain now at the portfolio level and even at a trading level. So a lot of people are booking the losses as well to adjust the books for the March end. So it's still far off for the March end, but still, that's the feedback that there is a bit of unwinding happening from the retail and HNI category. So that explains the flow perspective. FI large selling, no. Domestic redemption, maybe no. Yes, there is lack of buying interest from the domestic mutual funds. I guess technically, we've been saying this, right? 22,800 now is a level to watch out for. We've clearly broken the 23,300 support. Now the level to watch is 22,800. If that gets taken out, then you will see further selling or further panic in the large cap names as well. So that's overall feedback as far as flows are concerned. I guess it's more to do with the pain in the broader markets, and it looks like that's something to watch out for. But again, looking at just the data purely from the PCR data point of view, it's come to 0.65, and I've been saying for a while now that that's the level where normally we see a bit of a pullback. So hope for a pullback, but I haven't heard any big selling from FIs.
There are two factors out there. One is the PCR, the other is the FI net short positions, which has reached 1.75 lakhs. So ideally, these are the levels from where we should get a bit of a bounce. Yeah. That said, Nimesh, what about individual stocks?
So in terms of individual names, the first is a couple of the new age plays, so to speak, Zomato and Swiggy. Both are under pressure today. In fact, there was a Citi initiating report on Swiggy as well, but stock is down 6%, and there is selling pressure. Aggressive selling is what I understand from larger FIs. I guess the street is a bit worried about, there could be a bill for the gig workers to be included in the pension scheme, so that could have an impact. And maybe that explains there is selling in both those names today. The second stock is Interglobe Aviation. In a weak market, that's not very down, but there is buying as well. There is small buying, but there is buy flows from larger institutions in Interglobe Aviation at these levels. But again, for Interglobe Aviation, watch out for a potential large block, because the 5-month lockup seems to be over now for the Gunball. So that's something to track there. The third name is Goldium International. A sharp cut in that stock. Down 13% and large volumes as well. I understand there are sell-flows at HNI desk, and one leading HNI investor has been aggressively selling for the last couple of days there. And the last one is LIC Housing Finance. A lot of funds bought in anticipation of rate cut and a potential beneficiary, but now you're seeing a bit of reversal and a bit of whether you call it profit booking or genuine selling. There is selling in LIC Housing at these levels.
Okay, all right, got it. Nimesh, thank you very much for that perspective. Interesting, the market that we are in the midst of. Back to that conversation with Jitendra Sriram, Senior Fund Manager at Baroda Mutual Fund. Thanks, Jitendra, for just waiting by. Want to talk to you about now the sectors that you're still convinced on, or the pockets where you think, despite this volatility, I mean, say 2, 3, 4 months down the line, 5 months down the line, at least one is reasonably sure of returns because of the growth profile and the valuation comfort. Where do you find these safety zones in the market?
I think utilities, as I mentioned, exporters was the first one, the healthcare, IT sectors. The second, I would say, is utilities is looking fairly promising. You know, you had in the morning, you were putting out this thing about the kind of capacity growth, the kind of energy demand that's coming in the country as well. So those are something which are long-term drivers. So I know I can see that, you know, there has been a little bit of a pressure of late, but I think the longer-term story is pretty much intact in these names as well. And also the cost of borrowing is a big help because utilities typically work like an inverse bond as well. So to that extent, I would say that that space is something interesting. And lastly, I would say even pockets of consumer discretionary should be promising. You know, you have this huge amount of capital reaching out into the middle class. Where does it actually show up is a little bit questionable. I mean, in a sense that whether it is used to buy a two-wheeler or a four-wheeler or something like that. But the fact is you have higher disposable incomes, which should be positive. I think sometime in the next year, we should also be starting to hear the news flow around wage commission awards for government employees, and then it follows through for PSU employees and all that. So I think you have a 2-year kind of a run of income boosters coming in for the salaried class as well. So that should also do fairly well.
Got that. Jitendra, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC-TV18. So that's a quick conversation with Jitendra Sriram. Markets down about 320 points. I mean, there is some recovery which comes, fleeting recoveries, but that gets sold into very quickly. So, you know, I just saw Nifty was on 280, back down to about 320. So that's what you've got going. Advanced decline is at the bottom of the screen. Some 10:1 more in favor of advances at this point. We'll take a quick commercial break here. More market conversation comes up. We'll get you more opinion from a private equity perspective as well when we return. Jay Bala will also be with us for a technical perspective. Stay tuned.
Banker, but the first public sector banker in India after 70 years of banking in this country to be awarded the Padma Shri.
I was really grateful and humbled. No other public sector banker has been acknowledged.
Do you believe then that privatization is the answer?
I don't really believe that is the answer. There was a particular reason for which the public sector banks existed. Women need to feel fulfilled. If you are fulfilled in doing, staying at home, being a homemaker, great. But do not think of it as a sacrifice. I would tell them that, it's good for you to be a role model to your child.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Welcome back. There's some tiny slight recovery, if I could call it that, in the mid-cap market. What was earlier a 3.5% cut is now about a 3% cut, but it's still brutal. There's no taking away from that. Let's look at the top volume gainers and see what's moved up in the last 1 hour or so. Not too many names actually on the upside, hardly any to speak of. Largely still names on the downside. Lots of PSUs, NBCC, you have names like obviously IFCI, SAIL, RailTel. It's a bad day, bad afternoon for most PSUs. Okay, let's quickly move on and get some final trading advice from Mitesh. Mitesh, it's been quite a session. Final levels to keep in mind for the Nifty. Clearly, the long trades haven't worked 2 days in a row. And any final stock ideas?
I think, the index trade hasn't worked. But, on the stock side, I would suggest STVT. That will be on APL Apollo. Keep a stop at about 1392 and look for a target of maybe 1350, 1345 on the downside. And the other one is STVT on Bajaj Auto. Here, keep a stop at about levels of 87.91 for targets of 87.22.
Thank you very much for that. Let's get some more opinion then on the markets, the Indian economy and investment. Venture capitalists and PE fund managers still remain very bullish on India. Kedara Capital's Manish Kejriwal says the second half of 2025 will be a buyer's market, while Samara Capital's Sumit Narang says the deal flow in 18 months should accelerate. Listen in.
A significant amount of dry capital, as we said earlier, for sponsors. And India being globally relevant, whether it's China plus one, given what's happening to the Ukraine and the Middle East, it seems like even the strategics are refocusing on India. So exits, IPOs, of course, but in addition to that, the financial sponsors, because of all the dry powder we have and because we believe in India, and in addition to that, the strategics. So as a promoter or a GP which controls an asset, our exit options for the first time are multiple and very attractive. Sharon, I think if you look at what was clear is the time gone by. So when I look at 24, it was definitely a seller's market. We had IPO markets which were crazy. We all got exits. I think each one of us, we had more than 4 IPOs. We still have another 3 in the... It's gotten tighter now. So when it's a seller's market, buying was very difficult last year. The public markets eventually are an indicator where the private markets are going to go. And it hasn't been the most healthy start to a year. I think prices rightly will correct, the multiples will compress, and the second half of 25 will be a buyer's market much more than a seller's market.
If you see globally, as investors sitting globally, still India is, I think, on the expensive side on a relative basis, what they are seeing. So I think the markets will be subdued. And I think to each seller, if people like, even in our business, if a business needs to be sold and we need liquidity, and we're getting 10% lower than what we want, we would go ahead and do it. And I see the same behavior from, other motivated sellers and buyers respectively. But I think it will be a little subdued environment seeking liquidity.
Esteemed guests and friends, above all today, we express our deepest gratitude to our visionary Prime Minister, Shri Narendra Bhai Modi ji. Pandit Deen Dayal Energy University owes its very birth to his extraordinary vision. All of you are benefiting from what Narendra Bhai thought in the early 2000s. And when he called me and said in 2005 that we have to build one of the finest institutions in Gujarat, right? And that is what we have achieved from 2007 onwards. So we will always be grateful to our Prime Minister. Long before he became Prime Minister, he foresaw that India needed Atmanirbharta in energy. Over 20 years ago, he told me he wanted Gujarat to lead the nation in energy and energy products. He also told me that Gujarat should take the lead in cultivating world-class human resources needed to achieve India's clean energy ambition. That is how he helped establish this pioneering university. Friends, there are many things that we learn from our beloved Prime Minister. Let me mention just 2 lessons here for all of us. 1, Modi ji never lets a good idea go to waste. His Man Ki Baat inevitably becomes his Man Ka Sankalp. His Sankalp is always Vajra Sankalp. His determination is as hard as a diamond. He does not rest with simply making a sankalp. He knows how to turn his sankalp into success. In the last 10 years, the world has seen how he especially chooses impossible-looking tasks and transforms them into reality. This, for all of us, is lesson number 1. Lesson number 2 is about his boundless energy. Narendra Bhai Modi's name stands for Anant Shakti, infinite energy. Since PDEU is an energy-focused university, all of us should learn to be as energetic as our Prime Minister. People often ask the question, where does Modi ji take rest? Or does he rest at all? I can tell you that I know the answer to this question. The answer lies in what Pandit
Welcome back. Well, the markets are still down, but at least from the lows, we've seen some kind of recovery on some kind of, up move, at least on the Nifty as well as the Nifty Bank. Jay Bala joins us on the show. Jay, you've been calling it right that the Nifty could test lower levels, but going by the way that we have fallen and going by some of the technical indicators, do you think we could brace for a counter trend rally, or do you think it's going to be one way down?
It's never one way down, Nigel, and good to be here. I actually overestimated the strength of the counter trend move. I anticipated the market to touch somewhere close to 2400, but the markets have started caving in from 23,800 itself. So, it didn't allow opportunity to accumulate enough short positions on the index. So that's what the market it is. But, going forward, two stocks are going to be very important. One is Reliance, another one is SBI. Reliance, if it were to break 1200, not a good sign for the bulls. And I've mentioned that SBI has potential to cave in to somewhere close to 550. That will be dependent on what the stock does between 722 and 721. If the stock were to slice through like a knife on butter, then that's an indication that much deeper cuts are coming through, and that will have a very broad implication on the banking sector and the overall market.
Hi, Jay, good afternoon. It's turning out to be a really tough last couple of days. So, any individual level stock advice right now, or would you wait it out for the next couple of days to see where the market settles? Any stock trades?
Yeah, I have two bearish views on two stocks. One is Lupin. Lupin from 2400 hasn't, exactly declined in a corrective fashion. It's looking like a start of a reversal in trend. And it's bounced from 2000 odd levels to about 2225 in a corrective bounce. So, and today's decline is pointing to much deeper cuts for the stock. So, as long as the stock trades below 2225 or 2230, I'll be bearish on the stock. And the other one is AU Small Finance Bank, and it's been a rank underperformer. And the recent bounce from the January lows is sporting a corrective look. So as long as the stock trades below 620, I'll be negative on the stock and expecting more cuts to come through for the stock.
Okay. So got that. Those are individual names. Jai, hi, good afternoon. Just to get the Nifty view, are you expecting immediately lower levels, or are you expecting a bounce?
Yeah, I'm expecting minor bounce to come through, not anything tangible or pronounced one. So a bounces towards 23,300, 23,400 is likely to be met with further selling. I think the recent low that we saw in January, 22,700, I think it's a matter of time before it breaks. And we have been projecting every week from beginning of October, end of September, that the June 4th objective of 24,800. Sorry, 21,800, the closing basis, and the intraday low of 21,280. So that's the higher time frame objectives. The supports lie at about 22,700, which is the immediate lows. And once that's taken out, the support comes at about 22,100, and then anticipating a direct acceleration to the June 4th low.
Sorry, I'm jumping from sectors to asset classes, etc. But gold, of course, has been on a tear, and you have an interesting view here.
Yeah, that's right. See, gold, I put out a note when it cost 27.26 on London's spot gold, that it's heading for record highs, and had anticipated that to go to record highs, but silver not to get followed. And the markets have done exactly that. But the objective of gold was about 2850 to 2880, but it's exceeded that and come to about 2900 and change. So what gold does in the next few days is going to be pretty important. If it were to cave in, like I'm anticipating the next 2 days, then that's very dollar bullish and likely to see a lot of strength in the dollar and has implications for equity markets. But if it doesn't respond to in a negative fashion, it's going to probably go to 3,000 plus, which I'm anticipating to come through at a later date. So it might come through much sooner if it doesn't respond today or tomorrow. So that's an important implication for risk assets, because that has a direct implication on the dollar.
Okay. The only lone ranger on the Nifty that's finding a tiny hint of green today is Trent. Imagine it's the only stock, and that's after a dropping of almost 40% from the peak. Apart from that, all other 49 stocks on the Nifty are negative. It's that kind of an overwhelming afternoon. That's Trent. It's managed to pull back finally. Jay, I don't know if you've been tracking it, but I mean, the fall has been hard to miss or ignore on Trent, right? Any levels to keep in mind here? Is there any reason to at all look at any of these high-flying erstwhile winners?
See, the problem is Trent is good in the long term, but it's probably got short-term corrections to work with. The bounces, likely to hold on for the short term only, and not something meaningful or pronounced. So I anticipate some bounce to somewhere close to 5,800. But if you look at the overall market structure, the mid caps are below the January lows, and the FMCG index is below the recent swing lows. So it's all indicative of broader market weakness. So Trent as such, I don't think it's got potential to outperform or deliver significant short-term gains.
Okay. All right, Jay, thanks very much for the advice. Stay on. We'll come back to you and ask some more questions in the next show as well. But for the time being, let's quickly recap what has been another brutal day for the bulls. India once again underperforming regional markets, and the mid-cap carnage has been painful and deep. The mid-cap index over the last two sessions, just Monday and Tuesday, has lost 5%. The small-cap index has lost about 5.5%. So it's been massive unwinding. I'll just quickly name out some of the mid-caps which have taken it on the chin today. And it's a long list of stocks actually out there. Godfrey Phillips, 9% down. KFin, 10.5% down. Uno Minda, Elecon Engineering, Zaggle losing 10%. Just lots and lots of names. Prince Pipes is down 8.5%, 9%. Many names on the downside. If you're looking at the volumes charts, then even here, Railtel, Lemon Tree, PFC, Ircon, NBCC, Zomato, Sale. It's just you take a dart and throw it anywhere. Chances are it's going to land on the red side of the screen. But for what it's worth, Prashant, I mean, the bulls tried to defend 23,000. I guess sentimentally, that's the only positive at least I can find today.
Yesterday, same time, we were 23,300 was the 20-day moving average, right?
Yeah.
And that went and... sorry, 23,000 was around 23,000 was the 20-day, and that's been defended. But the point is, we are off sharply, 300 points once again, and this week is already turning out to be a pretty bad one. The Nifty has lost about 2.5%, and I was just looking at the cuts in the small and mid cap indices. Small cap index is down 18% from its all-time high, with today's 3.5% cut. The mid cap index is down some 16%. From its all-time high as well. So, we'll have to assess the damage in terms of individual stocks, what's fallen how much, and, what percentage of, say, for example, a group like NSE 500 is down more than 20%, 25%. We'll do all that and sort of, get you an overall picture a little later. But once again, a very poor day, and markets under a fair bit of selling pressure. It's a wrap on this edition of Closing Bell, but stay tuned. There's more coming up on markets forward. Surabhi and Nigel will take you through that in just a bit from now.
Upadhyay ji has said, who is the founder and whose name this university bears, has said about rest or Vishranti. He has said, Kaam mein badlav hi Vishranti hai. Change of work is itself rest. And I think this is our Prime Minister's motto. This should be our motto, dear students, also. Therefore, when we think about these two lessons, how to turn ideas into action and how to work tirelessly, we cannot escape the conclusion that Narendra Modi ji is not only India's Pradhan Mantri, but for us and this university, he is our Gurudev, our respected teacher, and we will follow his learnings.
आज जैन समाज का एक कार्यक्रम था बड़ौत में सीपीएल स्कूल में, जो पिछले 30 सालों से हर साल होता है। और यहाँ पे एक वुडन स्ट्रक्चर था जो कोलैप्स हो गया और अराउंड 40 लोग जो हैं वो घायल हुए हैं और उन सभी को 108 की एम्बुलेंस समय वहाँ पर मौके पर पहुँच गई थी। सबको हॉस्पिटल पहुँचा दिया गया है और 20 लोगों का प्रथम उपचार करके उनको घर भेज दिया गया है। बाकी 20 लोगों का उपचार अभी चल रहा है।
We must aim higher. Within a couple of years, India will emerge as the third largest economy in the world. No power on earth can stop India's growth trajectory. I can clearly foresee that India will become the most prosperous nation in the world before the end of this century. But India, with other large economies, also has a big responsibility. We must not allow economic growth endanger planet Earth and further worsen the climate crisis. Therefore, the transition from fossil fuels to clean and green energy has to be accelerated. I am supremely confident that green technologies and green enterprises can reverse the ecological degradation and indeed make our planet more beautiful, more livable for future generations. Our Prime Minister wants India to become the greenest nation in the world. For this purpose, India is also transforming itself into a deep tech nation with advanced manufacturing capabilities. This is the context in which PDEU should see its future role and responsibility. My dear PDEU family, therefore,
the market falls for the fifth consecutive session as Trump's tariff threats and selling by foreign investors weigh on sentiment. The Nifty ends with a 300-point cut, while the sensex tanks over 1,000 points. Realty stocks see deep cuts. Healthcare and public banks drag as well.
Midcaps fall under pressure amidst the sell-off. The midcap index slips 1,600 points. The midcaps are down 20% from the 2024 record highs and 6% in just 2 trading sessions.
Forex dealers left puzzled as the rupee makes a surprising recovery even as US tariffs on steel and aluminums kick in. RBI likely to have sold dollars in massive amounts. Sources say the move is an attempt to scare speculators.
Hello and welcome to a fresh edition of Market Sell-Off. I'm Nigel and with me is Surbhi. Surbhi, what a trading session it was. You seem to have indicated in the morning with this red color and it was red all the way. But I'll just say one point, I don't think we should lose heart. In the last 44 years or so, every year you've seen the index, the Nifty pull back closer on 10%, barring 4 years.
Yeah.
So that gives you some heart that sometimes corrections like these just tell you keep it going, keep your SIPs going, and ultimately, a longer span of time, things will turn around. The problem today was the broader markets, not the headline index, but there was pain in the broader markets.
Oh, absolutely. And we'll talk about this as we go over the next 20 minutes. We've got lots of perspective lined up on the show, both on technicals, on fundamentals, on the currency market, and what's happening with, of course, mid-caps as well. Just a quick word. What did we see in the market today? It was a slam dunk completely, and the pressure just kept mounting. The market opened with small cuts, and then the cuts just kept on getting deeper. The Nifty's, loss was about 300 points, 1.5%. But the crunching fall was really in mid-caps and small caps. But by the way, even on the Nifty, the Indian market again has underperformed global equity, second day running. So while the tariff headlines are big concern for markets around the world, India is falling more. Now, let me talk about this, fall that we had in mid-caps and small caps. In 2 days put together so far this week, the mid-cap index is down 5%, the small-cap index is down 5.5%, and stocks are falling across the board like 9 pins. So what's really going on? Well, I've been trying to sort of get some perspective from mutual funds, which are large players in the market. And the sense is that right now they're not seeing any kind of panic redemptions come through. In fact, flows in most fund houses, most AMCs, they've been positive so far in the month of February, and mutual funds are still net buyers in this market so far in February. So they're providing the support, but yes, there is FPI selling. The larger selling seems to be happening in the rest of the market, which could be HNIs, which could be family offices, which could be, of course, direct retail participation in stocks as well. That's where the unwinding is happening. And I got 2 reasons. Why are people selling mid-caps and small caps so much? 2 reasons, logical reasons that made sense was, one is the need to protect profits. Given the crunching fall in the market, you want to protect wherever you still have money left on the table. And that seems to be a part of the psyche that's playing out. And the second is tax loss harvesting. Remember, you can offset your losses against, gains, capital gains that you may have. And some of that technical factor could have been playing out as well. You want to book the losses to offset against future gains. So anyway, all things put together, it was a very, very weak session today once again for us, Nigel.
Well, that's right. And in fact, the rupee, that was the one that was in focus. It saw its strongest intraday in over 2 years. Dealers, they attributed the rise of the rupee to the RBI likely to have sold dollars in massive amounts. Lata joins us to decode the rally that we saw in the rupee in today's trading session. Lata?
Well, the rupee's rally is absolutely come out of the blue, and it is an extremely sharp rally. The rupee at its sharpest dealt at 86.63 and the overnight close was 87.46. So, it's almost a 1 rupee jump or a 1 percentage point rally in the rupee, and it is surprising because the dollar index has actually strengthened. Last week, Friday night, it was at 107.70 thereabouts. Monday, it went to 108.10. Tuesday, now it's at about 108.4. So dollar is strengthening. Almost all Asian currencies are weakening. Almost all. There's a minor green on the ringgit, but that's minor. Whereas the Indian rupee is extremely strong. And the only reason why it has been strong, the only person who's offering dollars like no tomorrow is the Reserve Bank of India. There are some huge numbers floating around, but all this is market chatter. People tell us that yesterday as well that the RBI must have sold well over $3 billion. Today, in the first half itself, they must have sold an equivalent amount. So the market is only trying to guess why is the RBI standing so much against the current of the foreign exchange flow. And it's not only peculiar to India. All EM currencies are falling. One guess is it wants the other side to come in and sell, the exporters. Typically, Jan, Feb, March is an export-heavy month. We do very well in exports. We sometimes have a current account surplus. So he's probably tempting the exporters to come and sell. Alternatively, they are scaring the speculators. You know, one day the rupee went from 86.50 thereabouts to 87.40. The next day it opened at 87.95, almost 88. I mean, this kind of speculative moves have to be stopped and the speculators have to be hurt. And that may be the position that the Reserve Bank is taking. But at the moment, all these are guesses.
Okay, Lata, got it. So maybe a bit of a reminder that, hey, we're also in the market and we can act when we wish to or choose to. Let's also hear out what the Chief Economic Advisor, Anantha Nageswaran, had to say on the Indian currency's weakness.
In the long run, which is 5 years or beyond, it is ultimately boils down to inflation differential. So in that sense, as long as our inflation rate is 1% or 2% above the average inflation rates of developed countries or the US, to that extent the currency will depreciate. But the point is, this currency depreciation hasn't prevented India from delivering returns to investors. If we are going to settle down at an inflation rate of around 3 to 4% rather than 5 to 6% as before, and if developed countries also end up finding that they can't bring it below 3% down, then naturally the gap between the two really shrinks a lot. And therefore, India may be able to experience a much lower rupee depreciation rate than what we have seen historically. And I don't think we should be too concerned about what is happening currently. This is an extraordinary period of dollar strength, which has lasted quite long.
Okay, all right. Well, let's get to the markets then, and let's welcome our guests. We have Jay Bal of CashTheKiosk.com, who will help us out with the technicals, and Sudeep Bandyopadhyay of Indie Trade Capital, who will help us with the fundamentals. Hi, gentlemen. Thanks a lot for joining in. Jay, you go first. We saw that counter trend bounce from 22,800 all the way to 23,800. Now we're closer to around 2,300. I think the call you were making earlier was for sub 22,000 levels. Is that on?
That's right, Nigel. See, the markets could see a very short-term bounce to about 23,300, 23,400, and then head on to break the recent low registered about 22,700 and change. The higher time frame objective has been the same since end of September, early October. That is the closing levels of June 4th and the intraday low, which is around 21,800 to 21,200. So the short-term resistance for the Nifty is 23,300 to 23,400, and the supports come in at about 22,700. If that were to given, the next support comes at about 22,100, and after that, it's directly to the June 4th low.
Okay, all right, got that. We'll come back to you, Jeff, for some more questions. But let's just go back and look at the broader market weakness that we've seen. Like I said, about a 5.5% correction at the index level in just 2 days, and a far deeper correction when you're coming down to individual stocks. We've got Sudarshan joining in. He's been looking at a lot of trends, including the FPI selling that has gripped this market. Sudarshan, tell us more.
So in the last few days, market has taken a big knock, especially in the broader markets, with both mid-cap and small-cap indices are now down 20% each from record highs that both these indices had hit in late 2024, and down 6% each just in last 2 days. And one of the reasons, if you can attribute, is big FIs selling. Just in 2025, FIs have sold shares worth nearly rupees 1 lakh crore in the cash market and nearly rupees 3 lakh crore if you see from the month of October 2024. And the impact can be seen in broader markets. Nearly 30% of total mid and small cap stocks are at or near to 52-week lows, with 70% of them are down 30% or more from their recent peaks. For Sensex and Nifty, the fall is 11 to 12% from the record high, both these indices that have hit in September 2024. But look at broader markets. Mid-cap and small-cap indices are almost in correction territory. Mid-cap index is down 17%, small-cap index has fallen 19% from record highs, Nifty Next 50, or earlier it used to be known as Nifty Junior, has fallen 22%, and Nifty Small-Cap 250 is down 90%. The fall looks more severe if you look at sectoral indices. Media index is down 32%, energy 30%, PSU 28%, realty 26%, and PSU bank 26%, and metal index is down 20% from their record high. So which of the stocks are top loser? Well, not even a single stock is at a 52-week high. And amongst top losers, PSUs are at top of the table. Top losers are MRPL, Cochin Shipyard, Vodafone Idea, Hind Zinc, Oil India and HUDCO, down somewhere in the range of 46 to 60%. And among small caps, top losers are Sterling and Wilson, Chennai Petro, Raymond, Jupiter Wagon, Titagar Rail and ITI, down somewhere in the range of 60 to 65%. And if there was any expectation from earnings, that too seems to have vanished, with number of companies missing estimates has been much more than the ones beating expectation. We'll have to see how the remaining calendar earnings pans out, and if any time soon FIs start buying. That's a big if, but that's what we can hope for now.
Okay, nothing wrong in hoping, but hope is not a data point. Thanks a lot for that, Sudarshan. Well, Sudeep, give us a couple of, good buy calls, because I'll tell you what, I was looking at the pattern, 2011, 2016, we did see the index pull back a little bit, to around these levels. So maybe if you follow that sort of a pattern, then maybe at most the index will pull back another 4 to 5% from here on. There just maybe, I know the rally has been very, very ferocious, but to give us a couple of ideas, what would they be?
Well, Nigel, I think, from a long-term investor's point of view, this can be a good opportunity for accumulating good quality stocks for 1 year plus kind of time horizon. And, I've been telling them to focus on the large cap universe because the valuation does look reasonable in some pockets. Look at BFSI. I think, this bucket definitely should be on an investor's radar. And, if you want to really play safe, go for SBI. It's a great bank. A lot of good things are happening. Interest rates are started coming down. So the way forward for SBI looks good. So buy SBI if you have to buy in the BFSI space. If you're looking at a slightly larger basket of BFSI stocks, which includes insurance, go for LIC. I think fundamentally, structurally, way forward for LIC looks very good. So buy LIC, forget the Q3 numbers, forget the Q2 numbers and this all the other parameters at this stage. Fundamentally, structurally, the way the business is poised, the way regulations are shaping up, I think LIC looks very good. Cement is another pocket where, Nigel, I'm very bullish. And, again, play safe, go for Ultratech. 170 million capacity already in the bag, gunning for 200 million, looking at acquisition. Costs very, very, carefully being looked at and being controlled. So in spite of the, pressure on volume, the performance has been good. Margins have improved. So Ultratech on the cement pack definitely looks good. And finally, I think my favorite, Reliance, I'm looking at a 1500 kind of a price, lot of triggers, value unlocking opportunities, and this correction definitely offers an opportunity. So these 4 stocks definitely should be looked at by investors building portfolio.
Can you name them once again? There's Reliance, Ultratech.
Reliance, Ultratech, State Bank of India, and
SBI. And LIC, got it. Okay, so 4 pillars to build your portfolio on without getting too scared in this market fall. Got that, Sudeep. Let me try and ask you the same question. Jay, of course, you've been very cautious on technicals. And again, this question doesn't apply to someone who's looking at a quick trade over the next 2-3 weeks. But is there anything in the market where the chart structure is still okay, not broken, which is showing relative strength in such a downbeat market, where perhaps from a portfolio perspective, one can look at buys?
See, one sector that's still not broken down is IT, and as long as IT index trades about 39,900, it's still positive. But my understanding of the technicals of the US markets, the tech sector in particular, that's very close to a significant top. So IT is the one sector where you can try to find hiding spots, but I'm not too confident because the leader, TCS, is very close to breaking down the January low, but the rest of the stocks are okay. And we discussed SRF last week. I tried to go deeper into the specialty chemical sector and see if the rest of the sector is doing something interesting, but no. It seems to be very specific to SRF, and SRF has broken out from a 5-year consolidation. So I would see what the stock does about 2,500 to 2,400. That will be an interesting entry point if this breakout is right to sustain, and probably the rest of the sector were to join. So these are the 2 I'm looking at from a portfolio perspective, but not too aggressively, very, very conservatively.
Got it, Jay. Just very quickly, Sudeep, you've given us 4 large cap picks. Is there any mid cap stock you want to add? Make it a 5 ka punch.
Yeah, I think, if I have to add one mid-cap stocks, I think Samvardhana Motherson is one stock. A lot of chatter around the tariff and how they will be hit and things like that. But I think with this correction which has happened, I think it's definitely worth buying. Anyway, auto ancillary is one space where I'm definitely positive, and I believe this company has a good future.
Okay. All right, gentlemen, thank you very much for joining in and giving us the perspective and advice on what has been a really difficult market. Thank you very much for being with us today. With that, we have to slip into a very quick break. As we do so, hear out some more commentary and market opinion. We also caught up with Rohit Srivastava of India Charts and also Adrian Moat to get a foreign perspective on the big sell-off that's underway in the Indian market. Back in just a bit.
I would expect that markets try to bounce back, loosen up the negative sentiment much more before you get another meaningful sell-off. However, the hard part would be to say the same thing about mid caps relative to large caps. I think that is where the next debate shifts then. But these are the nifty levels with which we'll be working, and still looking for that it does not significantly sell off yet. You might attempt another recovery into March. There may be further weakness in mid and small caps. After each bounce, they may still keep selling harder as we are seeing today. But somewhere the large caps may find support because money in the end has to go somewhere. A lot of money is flowing into funds. They will only reallocate. They will decide, okay, let's not buy too much of mid cap. Let's buy this. They're hybrid funds that will shift back and forth. And so at some level, you end up getting buying coming back to the large caps.
So there doesn't really seem to be any sort of technical level for the market at this point in time. And if you go back to your earlier point, which is the valuation of the market, this remains a very expensive market, which is justifiable if it is generating high growth. So this is going on against a backdrop of India being a big outperformer, emerging market funds having a good exposure to India, at a time where we've got rising U.S. interest rates, which put pressure on current account deficit countries, including India. And we've also, surprising, considering you'd think it would be the center of the trade dispute with the United States, Chinese equities doing quite well at the moment.
Here are my 3 expectations from all of you in the PDEU family. My first expectation, PDEU should further improve the quality of research and make it application-driven. We should specially focus on newer areas like bioenergy, which have the potential to help our farmers and boost employment opportunities. My second expectation, we should simultaneously increase our internal strengths and also forge national and global collaborations so as to enhance our leading position in research and academics. My third expectation, the intersection of green energy, green materials, and artificial intelligence is going to shape the future of humanity. I would like PDEU to gain a leading position in this synergy. Talking of artificial intelligence, I have a piece of advice to our young students. You must be good at using AI as a tool of learning, but do not give up your own critical thinking.
Welcome back to Market Sell-Off. Well, venture capitalists and PE fund managers, they have remained bullish on India. Manish Kejriwal of Kedara Capital anticipates the second half of 2025 to be a buyer's market, while Mukesh Mehta, the senior managing director at Blackstone, says that India has been their second best performing market over the past 5 years. They said this at the sidelines of the IVCA Conclave 2025. Let's listen to them.
Sharon, I think if you look at what was clear is the time gone by. So when I look at 24, it was definitely a seller's market. We had IPO markets which were crazy. We all got exits. I think each one of us, we had more than 4 IPOs. We still have another 3 in the... It's gotten tighter now. So when it's a seller's market, buying was very difficult last year. The public markets eventually are an indicator where the private markets are going to go. And it hasn't been the most healthy start to a year. I think prices rightly will correct. The multiples will compress. And the second half of 25 will be a buyer's market much more than a seller's market.
India is now the best performing geography for Blackstone globally for the last 5 years in a row. It's the 3rd largest geography for Blackstone globally after US and UK. That determines the importance of India. And as we speak, March 20th is when we complete 20 years. Our founder Steve will be in India to have that celebration. So we are very, very bullish on India. And you know, in this business, success breeds success. So more you deliver returns, more investors give you money to deliver more.
All right, well, there you heard it. Lots of perspective on the Indian market. Brutal fall today. Let's see, tomorrow, middle of the week, maybe we, get some good vibes coming through overnight.
Well, that's right. That's the hope, and hope is not a data point, but nothing long.
What we live on it.
Hoping. Well, on that note, we'll wrap up on the show. You stay with us. More news and updates coming up on the other side.
जरूर से इस्तेमाल करो, लेकिन याद रखो आर्टिफिशियल बुद्धि से नहीं, खुद की बुद्धि से हम आगे बढ़ेंगे और आप आगे बढ़ सकते हैं।
Hello and welcome to Business 360. I'm Arundhati Ramanan and these are the top headlines that we're tracking for you. Sensex and Nifty slide for the fifth straight session. Mid-caps and small caps get battered. 10 lakh crore rupees in investor wealth wiped out today. Forex dealers left puzzled as Rupee makes a surprising recovery even as US tariffs on steel and aluminium kick in. RBI likely to have sold dollars in massive amounts. Sources say the move is an attempt to scare speculators. Top private equity investors are bullish on India even amidst the market correction but remain wary of valuations and some IPOs are being put on the back burner.
No one holds the key to our collective future and shared destiny other than us humans.
Prime Minister Modi pitches India's AI story in Paris, says AI is writing the code for humanity, bats for developing open source systems that enhance trust and transparency. Elon Musk and a group of investors make an unsolicited bid of over $97 billion to take control of ChatGPT maker OpenAI. Sam Altman quickly rejects the offer and mocks Elon Musk by offering less than $10 billion to buy Twitter.
If all of the hostages aren't returned by Saturday at 12 o'clock, I think it's an appropriate time. I would say cancel it and all bets are off and let hell break out.
U.S. President Donald Trump issues an ultimatum to Hamas after it suspends the release of Israeli hostage alleging ceasefire violations. Trump warns all hell would break loose if hostages are not released by Saturday. Adani shares rise in a downbeat market. U.S. President Trump puts on hold the law which bars U.S. companies from bribing foreign officials. Bangladesh also asks Adani to restore full power supply after 3 months of reduced sales. Prime Minister Modi virtually inaugurates the India Energy Week and reaffirms commitment to sustainability, confident of achieving 500 gigawatts in renewable energy by 2030. Karnataka hosts a global business summit to woo investors, expects investment proposals worth at least 10 lakh crore rupees. We will come to that and more in just a bit, but first to what was a turbulent Tuesday for the Indian equity markets. Sensex and Nifty slid for the fifth straight session. 45 out of 50 Nifty stocks closed in the red. 10 lakh crore rupees in investor wealth wiped out today. The mid-caps and small caps suffered the most. Over 95% of India's top 100 mid-cap and small cap stocks closed with cuts. Sudarshan Kumar joins us now. Sudarshan, decode that sell-off for us on Dalal Street.
So in the last few days, market has taken a big knock, especially in the broader markets, with both mid-cap and small-cap indices are now down 20% each from record highs that both these indices had hit in late 2024 and down 6% each just in last 2 days. And one of the reasons, if you can attribute, is big FI selling.